Welcome, everyone, to today's panel discussion. Our topic today is a big one that affects many people, whether they're seasoned investors or just starting out: the stock market and the risks and benefits that come with it. With us again are Jordan, a financial advisor who's well-versed in market strategies, and Taylor, a recent college graduate who's just beginning to dip their toes into the stock market. Thank you both for being here.
It's great to be here, Alex. The stock market is one of my favorite topics because it offers so much potential, but requires a lot of understanding to navigate effectively.
Thanks for having me back. I've been curious about investing, but I have to admit, it feels intimidating, especially with all the talk about risks and market crashes.
That's a great place to start. Jordan, can you give us an overview of what the stock market is and why it's such a popular investment option?
Absolutely. At its core, the stock market is a marketplace where shares of publicly traded companies are bought and sold. When you buy a stock, you're essentially buying a small ownership stake in a company. The reason it's such a popular investment option is that, over time, the stock market has historically provided higher returns compared to other investment vehicles like bonds or savings accounts. It allows investors to benefit from the growth and success of companies.
That's a helpful explanation. But I've also heard that the stock market can be really risky. Can you break down the risks for someone who's just getting started?
Of course, the biggest risk in the stock market is volatility. Stock prices can fluctuate significantly in the short term due to various factors, including changes in the economy, political events, and company performance. If you invest in stocks, there's always a chance you could lose some or even all of your investment, particularly if you sell when prices are low. That's why it's important to have a long-term perspective and not react emotionally to short-term market swings.
That's a great point. Let's talk about this volatility. Taylor, as someone new to investing, how do you feel about the idea of your investments potentially losing value?
Honestly, it makes me nervous. I've saved up a little bit of money, but the thought of losing it, even temporarily, is scary. I'm not sure how I would handle seeing my investments drop in value.
That's a completely normal reaction, Taylor. No one likes the idea of losing money, but it's important to remember that market fluctuations are a natural part of investing. What's crucial is your mindset and your time horizon. If you're investing for the long term, say for retirement 20 or 30 years from now, short-term drops shouldn't worry you too much. Historically, the stock market tends to recover and grow over the long term.
I've heard that before, but it's still tough to not panic. How do you manage the fear of losing money?
It's all about having a plan and sticking to it. One way to manage risk and avoid panic is by diversifying your investments. Instead of putting all your money into one stock, you spread it across different companies, industries, or even different asset classes like bonds or real estate. This helps reduce the impact of any single investment doing poorly. Diversification is often called the only free lunch in investing because it reduces risk without sacrificing potential returns.
Diversification definitely seems like a smart strategy. Jordan, could you explain how an average investor can diversify their portfolio, especially someone like Taylor who's just starting out?
Sure. The easiest way for a new investor to diversify is through mutual funds or exchange-traded funds, ETFs. These funds allow you to invest in a basket of stocks, so you get exposure to many different companies at once. For example, instead of buying shares in just one tech company, you could buy an ETF that holds shares in dozens of different tech companies, or even an ETF that covers a wide range of sectors like healthcare, energy, and consumer goods. This way, you're not dependent on the success of a single company or sector.
That sounds a lot less risky than buying individual stocks. I've heard of ETFs before, but how do I know which ones to pick? There are so many options out there.
That's a great question. It's true, there are thousands of ETFs and mutual funds to choose from, which can be overwhelming. One good place to start is with broad market index funds, which track major indices like the S&P 500 or the Dow Jones. These funds give you exposure to a large portion of the market and tend to have lower fees than actively managed funds. They're a simple, low-cost way to get started with investing and benefit from the overall growth of the stock market.
Index funds are a popular choice for many investors. Let's shift the focus a bit and discuss the potential benefits of investing in the stock market. Jordan, what are the main advantages of putting your money in stocks, especially when compared to other investment options like bonds or savings accounts?
The primary benefit of investing in the stock market is the potential for higher returns. Over the long term, stocks have consistently outperformed other asset classes like bonds, real estate, and certainly savings accounts. While bonds offer more stability, they generally provide lower returns, especially in today's low-interest rate environment. Savings accounts, though safe, barely keep up with inflation. On the other hand, if you're patient and can ride out the market's ups and downs, stocks can help you grow your wealth significantly over time.
That sounds appealing, especially since my savings account isn't earning much interest at all. But with all the risks involved, when is the right time to start investing in the stock market?
The best time to start investing is as soon as possible. Time is your greatest asset as an investor because of something called compounding. When your investments earn returns and those returns are reinvested, you essentially start earning returns on your returns. Over many years, this compounding effect can lead to significant growth. Even if you're just starting with a small amount, getting into the market early allows you to take advantage of compounding.
Compounding is one of the most powerful concepts in finance. Taylor, does that idea of starting small and letting time work for you resonate with your approach to investing?
It definitely does. I've been hesitant to invest because I feel like I don't have enough money to make a difference. But hearing about compounding makes me think it's better to start with what I have. I didn't realize how much time could work in my favor, even with a small amount of money.
Exactly. Many people think they need a lot of money to start investing, but that's not the case. With modern platforms, you can begin investing with just a few dollars, and the sooner you start, the more time your investments have to grow. Even if your contributions are small in the beginning, they can build up over the years.
That's encouraging. Let's now dive a little deeper into risk management. Jordan, you mentioned volatility as one of the main risks in the stock market. What other risks should investors be aware of?
Besides volatility, there are several other risks to consider. One is market risk, which is the risk that the entire stock market declines due to economic or political factors. There's also company-specific risk, where a particular company's stock might fall because of poor management, bad earnings reports, or changes in industry regulations. Another risk is inflation risk. If your investments don't grow at a rate that keeps up with inflation, your purchasing power will erode over time. Lastly, there's liquidity risk, which refers to the ability to sell your investments when you need to. In some cases, stocks or assets can be difficult to sell quickly without losing value, though this is more common with smaller, less liquid stocks or alternative investments.
Wow, that's a lot to consider. I hadn't thought about liquidity risk or inflation risk before. It's starting to sound like investing in the stock market can be really complicated.
It can feel that way, but it's manageable with the right approach. The key is to stay informed and have a clear strategy. You don't need to know everything about the market to be a successful investor. In fact, many people do just fine by sticking to simple, low-cost strategies like investing in index funds. And always remember to only invest money you won't need in the short term.
That's a reassuring perspective. Let's talk about emotions and investing. Taylor, how do you think you would handle the emotional side of investing, especially during market downturns?
I think that's one of the things I'm most worried about. I've heard stories about people losing money during market crashes, and I'm afraid that if I see my portfolio losing value, I might panic and sell at the worst time. I don't want to make emotional decisions, but I know it could be hard to stay calm if things go south.
That's a common concern, Taylor, and it's a challenge even for seasoned investors. The emotional side of investing can be tricky because it's natural to want to avoid losses. But one of the best things you can do is to remind yourself of your long-term goals. If you have a well-diversified portfolio and a long investment horizon, market dips are temporary setbacks rather than reasons to panic. Many investors make the mistake of selling in a downturn, locking in their losses. It's important to stay disciplined and stick to your plan, even when the market is volatile. That's why understanding your risk tolerance is key. If you know you'll have trouble dealing with big market swings, you might want to have a more conservative portfolio That includes bonds or other less volatile assets.
That's a great point. Investing can be emotional, but having a plan can help keep those emotions in check. Taylor, do you think knowing that market downturns are normal might help you stay more confident if the market does take a dip?
Yeah, I think that helps. Knowing that downturns are part of the process and not the end of the world makes it feel less intimidating. I just have to remind myself not to react impulsively and to trust the process.
Exactly. Remember, markets are cyclical, and while downturns happen, so do recoveries. If you can hold on through the rough patches, you're likely to see the rewards over the long term. One trick is to avoid checking your portfolio too often, especially during volatile times. That way, you're not constantly tempted to make changes based on short-term movements.
That's solid advice. Now, we've talked a lot about risks, but let's shift back to the potential rewards. Jordan, can you explain how investing in the stock market can help people achieve their financial goals, like buying a home or saving for retirement?
Absolutely. The stock market can be a powerful tool for achieving long-term financial goals because of its potential for high returns. Over time, stocks tend to outperform other investment options, which can help you grow your wealth faster. This makes the stock market ideal for goals that are many years away, like retirement, where you have time to weather any volatility and benefit from the market's long-term growth. For example, let's say you're saving for retirement and you start investing early in your career. Even if you're only contributing a small amount each month, the power of compound interest can turn those contributions into a substantial sum by the time you retire. This is why the stock market is such an important part of retirement planning.
That's motivating. I know retirement feels a long way off for me, but I'd love to be in a position where I'm financially secure by the time I get there.
Exactly, and the earlier you start, the more options you'll have down the road. It's not just about retirement either. You can use the stock market to save for other long-term goals like buying a house, funding your children's education, or even starting a business. The key is matching your investments to your time horizon and risk tolerance.
It sounds like the stock market, while risky, can be an excellent tool for long-term growth and achieving major life goals. As we approach the end of our discussion, I'd like to ask both of you to share some final thoughts. Jordan, for someone who is hesitant about investing, what advice would you give?
My advice would be to start small and stay informed. You don't need to have a lot of money or be an expert to begin investing. The most important thing is to take that first step, whether it's opening a brokerage account, buying your first ETF, or just learning more about how the market works. Over time, you'll become more comfortable and knowledgeable, and you'll start seeing the benefits of having your money work for you.
Great advice. Taylor, what's your biggest takeaway from today's discussion?
I think the biggest thing for me is understanding that risk is a part of investing, but it doesn't have to be something that scares me away. With diversification and a long-term approach, I can manage the risks and hopefully see my investments grow. I'm feeling more confident about starting, even if I'm just putting in a small amount at first.
That's wonderful to hear. Thank you both for such an insightful discussion. The stock market offers both risks and rewards, but with the right approach, it can be a powerful tool for building wealth and securing your financial future. I hope our audience feels encouraged to start their own investment journey or refine their strategy with these insights. Thank you, Jordan and Taylor, for sharing your perspectives today.
Thanks for having me, Alex. It was a pleasure to be part of the conversation.
Thank you. I learned a lot, and I'm sure others did too.
And thank you to our audience for tuning in. Until next time, remember that investing is a long-term game, and with patience, discipline, and knowledge, you can achieve your financial goals. Take care, everyone.